Okay, let's go.
Standard technical analysis suffers from a severe latency problem. By the time a moving average or a momentum oscillator confirms a trend has changed, the move is already well underway. Relying strictly on these lagging indicators means entering trades late. You end up buying after the smart money has already positioned itself, exposing your capital to sudden pullbacks. To solve this, we can look at a visual data format designed specifically to capture immediate shifts in momentum, the candlestick chart. Every candle plots 4 data points: the open, high, low, and close. These markers reveal the specific moments where buyer and seller conviction shifted throughout the session. The opening price is typically driven by amateur emotion, retail traders reacting to overnight news. By contrast, the price at the closing bell is dictated by the calculated consensus of professional institutions. The distance between that open and close forms the real body, while the price extremes form the shadows, or wicks. The resulting geometry acts as an anticipatory indicator, warning us of an impending shift in supply and demand before it registers on traditional metrics. However, trading a single candlestick pattern in isolation creates a mathematical vulnerability. A shape alone does not guarantee a reversal. High-probability trading requires a specific 3-part framework. We need an anticipatory signal from the candlestick, verification that the market is at a contextual extreme, and finally, lagging confirmation to prove the trend has actually fractured. This 3-part matrix aims to validate reversals through independent layers of evidence. We begin by identifying moments of absolute market equilibrium, sessions where buyers and sellers fight to a standstill. This stalemate forms a specific candlestick known as a doji. It appears when a trading period opens and closes at the exact same price, leaving a horizontal dash instead of a thick real body. If a doji forms in the middle of an active trend, it is usually just a temporary pause. But when a doji appears at a structural price extreme, it acts as a warning. To verify that the market is actually at an extreme, we use a mathematical boundary like the Bollinger Band. A price pushing outside the upper band indicates an overbought state. This daily chart of AMR Corporation highlights a mid-June peak testing the $14.95 level. Right at that peak, a gravestone doji appears. Its long upper wick pierces the top Bollinger Band, but by the close, the price retreats to the open. This geometry tells us exactly what happened. Amateur bulls tried to drive the price higher, but professional sellers rejected that high altitude, exhausting the buying pressure. The consequence of this rejection is clear. The buying support vanishes, and the stock declines over the following weeks. The doji gave the anticipatory warning, but it only became an actionable signal because it formed precisely at a mathematically verified extreme. The exact same logic applies in reverse, when a market is trapped in a prolonged oversold trough. Here, we look for a pattern called the hammer. To qualify as a true hammer, the candlestick must have a small real body and a lower shadow that is at least twice the length of that body. The long lower shadow reveals aggressive early selling drove prices down, but before the close, professional accumulation absorbed that supply, completely reversing the direction. This chart of the Nasdaq Composite shows a multi-month downtrend. At the very bottom of this steep drop in late April, a hammer candle forms right at the 1900 support level. To validate that this hammer is actually a bottom and not just a dead cat bounce, we check our secondary tool, the stochastic oscillator, which measures momentum. We look for bullish divergence, a disconnect between price action and momentum. While the main price chart makes lower lows, the stochastic lines at the bottom make higher lows. This deceleration in downward momentum happens exactly as the hammer forms. The underlying metrics show that the bears have exhausted their supply. A bottom reversal candlestick becomes a trustworthy signal when the momentum oscillators show the trend is losing strength. Identifying the signal and verifying the extreme is still not enough. We need the third pillar of the framework, lagging confirmation. This introduces a strict protocol known as the Rule of Two. It demands waiting for the subsequent trading period's price action before executing trades. You do not trade the candlestick itself. You trade the market's validated reaction to that candlestick. This is a daily chart of the Disk Drive Index following a 20% rally. In mid-June, 2 consecutive dojis form, labeled here as number 4. These dojis signal a stalemate against the upper Bollinger Band. However, shorting here is reckless without confirmation. To enforce the rule of 2, we look to the 4-day and 9-day moving averages. Validation arrives in the days immediately following. The 4-day moving average crosses sharply below the 9-day line. This micro crossover serves as the final trigger, locking in concrete downward momentum to back up the candlestick's anticipatory warning. Failing to enforce this rule turns a valuable edge into a premature trap. Waiting for that confirmation protects your capital from false reversals. Over a 6-month index consolidation, this framework identifies the specific technical events that mark the boundaries of the range. This Dow Jones chart displays a sideways consolidation between 10 and 11,000. At the first major peak, a gravestone doji forms at 10,853, rejecting resistance. The index then drops to the 10,000 support floor, where a bullish engulfing candle reveals buying interest. The subsequent rally is stopped by a second gravestone doji at 10,405, warning of a stalled advance. Finally, the sell-off bottoms with a hammer candle at 10,175, leaving a footprint of accumulation before pivoting higher. The sequence is strict. First, you define the mathematical extremes using bands or momentum oscillators. Second, you analyze the anticipatory geometry of the candlestick to spot immediate shifts in buyer and seller behavior. And third, you demand lagging confirmation through the rule of 2 and short-term moving averages. Candlesticks are not magic shapes, but when treated as behavioral evidence and processed through a rigid structural matrix, they allow traders to anticipate shifts in trend.